The IS audit process involves looking at the risk to assets that have value to an organization and the security controls that mitigate those threats to make sure that they're effective and that they're efficient and that they meet control objectives. In this scenario, we're going to focus on security control cost effectiveness. In our example, let's assume that our client gathers market research data that it then sells to marketing firms, and it's set a value on those market research databases at $250,000 in total. However, a single security breach due to historical past incidents could end up costing up to $10,000 if a security breach occurs against the market research databases, so $10,000. And security breaches are estimated to occur once every 36 months. So in other words, once every 3 years. So given this information, as an IS auditor, we need to start thinking about, well, what kind of security controls are currently in place, how much do they cost, and are they effective? Because if not, we'll have to look at new solutions and then determine if they're worth investing in. Or in some cases, if it's cost prohibitive, maybe using some kind of a compensating control that still meets control objectives. So let's say that we determine that protecting the market research databases has an annual cost of $2,600. Now we might have arrived at this by assessing the current security controls to determine that they are deficient. They do not protect the market research databases sufficiently. They might have at one point in time, but they no longer do currently. And so maybe we have to invest in some intrusion detection and behavioral analysis malware scanners to further protect the databases adequately, again, to meet control objectives. So the question becomes, should our client invest in protecting the databases at this cost? Well, the answer lies in mathematics. In this case, the answer is yes. Investing in protecting the databases at an annual cost of $2,600 is worth it. But how do we know that? How can we back up that assertion? Well, we can look at the annual loss expectancy, the ALE, which is derived by multiplying the single loss expectancy times the annual rate of occurrence. Now, in our example, that means taking $10,000, that's a single loss expectancy cost, multiplied by the annual rate of occurrence, that was once every 3 years, once every 36 months, and when we multiply those together, we get $3,330.